I had a great conversation with the veteran strategist Ed Yaradeni about the fact that it could turn out that the selling pressure we had seen recently in stocks could open the door of opportunity for some investors. Our next investor has his eyes on a few particular names, and let's talk to him now. Matt Orton is Chief Market Strategist at Raymond James Investment Management. Matt, I always think back to, Warren Buffett's comments around not understanding why people get worried when stocks go on sale. I guess the challenge is when there's so much uncertainty in the air, you just don't know whether that feels like the right moment, if there's more uncertainty to come. So how are you thinking about the fact that we did see stocks come off their recent all-time highs?
Hey, good morning, John. Always great to join. And I think the context for investors is stocks can go down for a number of reasons. When there's a growth scare, which is what I think we're going through right now, which is led by all of the uncertainty we have with respect to policy and what the ultimate read-through is going to be to the economy, it's understandable that investors, after two really, really strong years in the equity market, might be looking to take some profits or start to rotate away from the winners of yesterday and into maybe some safer pockets of investment. So what I remind clients is the overall fundamental for the picture for the market, which is predicated on earnings, that remains really solid, and we're seeing good breadth beneath the surface. So to me, you can hide out in safety. Dividend growth is working incredibly well so far this year, but there's also some really good companies that have been thrown out with the bathwater in sectors that are favorably placed with respect to policy that we're seeing, say aerospace and defense, or technology, where there's going to be continued investments by companies, businesses, and the government.
Okay, that's a helpful backdrop for going through a few different names. I'm going to start with a well-known technology company, and that is Uber. And Uber shares have been under some recent pressure, but before the recent pressure, it was actually one of the hottest names of the year. And it almost felt to me like, because I look at the Bloomberg expectations on things like profit, there are very few companies that are expected to have the kind of profit growth in percentage terms over the next few years as Uber. And even if they're coming off a low base, it really is astounding to look at. What do you see in a company like Uber?
So, John, Uber is a great story of what I like to tell clients to do is lean into quality and don't chase the market to the upside. Let it come to you. After the big sell-off on Uber that we had, it was really predicated on an overestimation of the impact of self-driving vehicles, that Uber wouldn't be able to compete because of the Teslas and the self-driving technology, but that is not playing out. And I think when you look at a company like Uber that's been increasing its free cash flow, it's got a decent balance sheet, and it's making investments in partnerships for self-driving technology, as well as continuing to expand really high growth drivers of its business, such as Uber Teen and Uber Eats. Those areas are doing very well. So again, it comes back to the fundamentals and looking for growth, and consumers aren't slowing down. Traveling consumers aren't slowing down, kind of the convenience of having deliveries at home. So those are great growth markets that are durable outside of the policy fog that we might be stuck in.
Really helpful context there. Earlier, we had a conversation about a cybersecurity company, CrowdStrike, which is struggling today. But one of the observations I've had with their business is they've got really good free cash flow margins, the ability to take every dollar of revenue and turn it into free cash flow. And you've got a company on your list, Visa, which, I always have to do a double take when I look at things like profit margins for Visa. They are amazing, and you like the company as something worth recommending to people today.
Absolutely, John. Visa is a machine. When you look at the chart of this company, it just continues to move up and to the right, and it's a steady compounder. I liked it as a complement to a portfolio that might have some additional tech or growth exposure, but leaning into financial services, which has held up very well on this uncertainty because of the visibility of its earnings growth and the consistency with respect to how consumers make purchases, that makes Visa very, very attractive, coupled with, like you'd mentioned before, a very strong strong balance sheet, free cash flow generation. But again, Visa has been growing not only because consumers continue to spend money and they're able to maintain their market share, but they're also making investments in their businesses and finding ways to unbundle the service offering to clients and businesses. So Visa as a service is, is a strong double-digit growth engine of Visa. So basically unbundling card services from security and information protection that can complement its overall growth drivers from just the credit card. So again, I like it because they're building new areas of growth and leaning into the very strong competitive advantage that they already have.
Matt, we're almost out of time, so I'm going to be quicker with this last one. Axon Enterprise, which I always see the stock and forget the fact that this is the company behind Taser.
Yeah, absolutely. It's a defense tech company. It was one of my top picks last year. They make Taser, but what's more important about Axon is they also make body cameras. They make a lot of technology cloud storage for a lot of the usage of police with respect to those body cameras. So it's really the full tech offering that's driving a lot of their growth. And again, they're rapid double-digit growth company, really strong EPS. They just had a really good earnings season, and yet the stock was still down about 30%, through all of this volatility we have. So this, again, is a name that I want to pick up at a discount rather than having chased it higher. So I think the entry point right now, given the very strong backdrop it has and where governments are making investments in the police force and what Trump wants to make investments, I think this company looks very attractive at the current levels.
Matt Orton of Raymond James Investment Management, we appreciate your time and some interesting